Welcome to The Debate. Today, we are dissecting a scenario that I know keeps many of our listeners up at night. Picture this. You're a high-income earner, a specialist, a surgeon, a tech executive, a partner at a law firm. You've done everything right, according to the textbook. You look at your portfolio, and it is a fortress of diversification. I mean, hundreds of tickers, global exposure, factor tilts. It looks bulletproof. But it feels stagnant. It's safe on paper, yet it just seems to be dragging, underperforming your own earning power. Meanwhile, there's that one high-conviction bet, that specific company, that sector you know inside and out, that keeps pulling at your attention.
Right. It's the itch that modern portfolio theory just can't scratch. You see the winners, you know the industry better than the analysts on Wall Street, but your capital is spread so thin across the index that your portfolio barely registers the victory. You feel like a spectator in your own financial life, watching others get rich on insights you actually possessed.
And that brings us to the core question we're wrestling with today. Is diversification prudent engineering that ensures your financial survival, or is it, as you might argue, a performance tax that guarantees mediocrity and, well, dilutes the very wealth creation our listeners are capable of?
Look, my stance is clear. We're talking about the paradox of protection. I believe that for the sophisticated investor, diversification often morphs into what I'd call diversification. It masks opportunity costs, it dilutes your best ideas, and it substitutes the feeling of being responsible for actually being effective.
And I'll take the position that diversification is protective engineering. In a world of fragile careers, unknown correlations, and sudden regime shifts, concentration is not conviction. It is unpriced tail risk that impairs your optionality. You might feel like a genius in a bull market, but I'm here to make sure you survive the bear.
Then let's tear down the walls of this fortress you love so much.
I want to start by framing the reality for the high-income professional because context is everything. The primary goal for this cohort isn't necessarily hitting a home run on every swing, it is capital preservation to allow the mathematics of compounding to actually work. We have to look at the asymmetry of loss, a concept highlighted in the optimization paradox research. The math is, it's brutal and unforgiving. If you take a 50% drawdown on a concentrated position, you don't need a 50% gain to get back to even. You need a 100% gain just to recover.
That's standard arithmetic, sure. But it assumes you're going to lose. It assumes the default state of the market is danger and that the investor is, helpless to avoid it.
It assumes the possibility of loss, which is the definition of risk management. But let's go deeper into the mechanics, because I think people gloss over this. There's a concept called volatility drag, which Abscess and Verdad have analyzed extensively. This is where the engineering mindset is crucial. Listeners need to understand that your geometric mean return, what you actually take home and spend, is always lower than your arithmetic mean return because of volatility.
Explain that distinction, because on a spreadsheet, an average is an average. If I average 10% a year, I average 10% a year.
Not in the real world. Let's say you have a concentrated portfolio. Year 1, you go up 50%. You feel like a hero. Year 2, you go down 50%. So your arithmetic average is 0%. You broke even, right?
Seems like it.
Wrong. If you start with $100, go up 50% to $150, and then drop 50% from there, you are left with $75. You lost 25% of your wealth, even though your average return was 0. That gap, that disappearance of money, is volatility drag.
Okay, the math holds up. I can't argue with the calculator.
And it scales. High volatility from concentration creates a mathematical tax on wealth compounding. If you're running a concentrated portfolio with, say, 30% volatility, you are suffering roughly a 4.5% annual drag on performance compared to a smoother, diversified portfolio. That is an invisible tax that destroys wealth over decades. You are pedaling uphill against the math.
See, this is where the engineering mindset misses the forest for the trees. You're worried about the drag on the portfolio, but you're ignoring the drag of mediocrity. You're trying to avoid the potholes so desperately that you're driving 20 miles an hour on the Autobahn. I'm arguing that diversification guarantees you will hold all the value destroyers in the market.
Value destroyers? You mean the losers?
I mean the garbage. If we look at the data from Portfolio Pilot, the reality of the stock market is incredibly skewed.
This is a statistic that should keep you up at night. Since 1926, just 4% of U.S. stocks accounted for all net wealth creation. All of it. The other 96% effectively netted out to Treasury bill returns.
That is a staggering statistic. I'll grant you that. It implies the market is a lottery where very few tickets pay out.
It's not just staggering, it's the whole ballgame. If you diversify broadly, strictly buying the index, you are mathematically guaranteeing that you dilute that critical 4% with the 96% of mediocrity. You are missing the magnitude of the winners to avoid the volatility of the losers. And to back this up, look at the UT study regarding mutual fund managers. It found that managers' best ideas, their highest conviction concentrated picks, systematically outperformed their own diversified portfolios.
So the argument is that they're good stock pickers, but bad portfolio constructors?
Exactly. When they diversify, they are stripping away their own edge to satisfy a mandate or a compliance department. They are forced to buy their 20th best idea, their 50th best idea. By the time you get to the 50th idea, you don't have conviction, you have filler. This is diversification, a term Investopedia defines well, adding assets that worsen your risk-return trade-off. High earners usually have a right to win in their specific domains. They understand the landscape better than Wall Street does. They should leverage that, not dilute it into an index fund alongside everyone else.
I see why you think that, but let me give you a different perspective on this right to win. You're talking about the mathematics of success, catching that 4%. But we need to talk about the mathematics of ruin versus the illusion of safety. You claim concentration wins, but at what cost to the nervous system and the probability of total failure?
I'm ready. Let's talk safety. Because I challenge the premise that diversification even equals safety. I think that's a marketing term sold to retail investors to keep them docile.
Go on.
Look at the Verdad study. They compared the Dow 30, a highly concentrated index of huge companies, against the S&P 500. Since 1969, the concentrated Dow actually had lower volatility than the diversified S&P 500. Adding more tickers didn't make it safer, it just added noise. Verdad uses this fantastic analogy about bird counting.
Bird counting? Please tell me this involves actual birds?
It does. Research shows that humans and birds, apparently, struggle to discriminate quantities beyond 3. We see 1, 2, 3, many. That's just how our brains work. When investors build portfolios with 100 or 175 stocks, which is the median for many funds, they are suffering from idiosyncratic overkill. They aren't actually reducing risk anymore. The marginal benefit of the 50th stock versus the 51st is 0. They are just bleeding out alpha because their brains, like the birds, can't distinguish the value. They've just reached many. It's a cognitive limitation disguised as a strategy.
That is a compelling analogy, and I enjoy the image of a fund manager counting like a crow. But I'm not convinced by that line of reasoning because it relies heavily on looking at the winners. You mentioned the Dow 30, which is a list of survivors, companies that didn't fail. This brings up the Acadian research on survivorship bias. You and many proponents of concentration point to the Forbes 400 or the Dows as proof that concentration works. But Acadian rightly points out that this ignores the graveyard of concentrators who went to 0.
The graveyard is full of bad ideas, sure, but we're talking about smart investors here, people who do their homework.
No, not just bad ideas, competing ideas. Acadian uses the example of Coca-Cola. Sure, if you concentrated in Coke, you're rich. But what if you concentrated in Toco Tonic or Zimba Cola?
I haven't heard of them.
Exactly, that is my point. Those were real competitors at one time. The Toco Tonic investor didn't make the Forbes list, they went broke. Acadian argues that while some concentrated funds win, concentration is generally preferred by innumerate, overconfident investors.
Innumerate, that's harsh. You're calling the most successful entrepreneurs in history innumerate?
It's what the data suggests for guarding investors, not entrepreneurs. There's a massive difference between building a company and picking a stock. And for our high-income listener, the stakes are higher. WealthKeel highlights a terrifying scenario for the modern professional: over-concentration in company stock. Let's make this real. If you work in tech and your income comes from tech, and you hold 20% or more of your net worth in tech RSUs, You face a double whammy.
Meaning the correlation between your paycheck and your portfolio?
Exactly. If that sector turns, you lose your job and your portfolio value simultaneously. Remember Enron. That is the ultimate failure of concentration. Employees had their 401ks in Enron stock. When the ship went down, they didn't just lose their income, they lost their future. That isn't just volatility, that is ruin. You cannot recover from zero.
Enron is the extreme case, the black swan of fraud. But let's pivot to the mechanism of growth because you're focused on the defensive crouch. I'm talking about behavioral alpha. Diversification often results in closet indexing with high fees, as noted in the optimization paradox. You're paying active management fees to get passive results. You're paying a Mercedes price for a Honda Civic.
But you're paying for the risk management, you're paying for the airbag.
Are you or are you paying for indecision? Consider the Kelly criterion. This is fundamental gambling and investment theory. It states that if an investor has an informational advantage, which many high earners do in their specific fields, investing proportionally to that edge is the only rational mathematical move.
So bet big when you know the odds are in your favor.
Precisely. If you are a software engineer and you spot the next platform shift before Wall Street does, betting 2% of your portfolio on it isn't prudent. It's mathematically wrong. You should bet the size of your edge. If you dilute that insight with 49 other stocks you know nothing about, you are mathematically throwing away value. You are deliberately making yourself poor.
That's an interesting point, though I would frame it differently regarding the cost of diversification. You call it a fee or a drag. I call it a tool for tax efficiency. We can't ignore the tax man. Range.com discusses tax loss harvesting. Diversification provides the raw material, the losers, to offset your gains. In a concentrated portfolio, if you win, you have a massive tax problem. If you lose, you have a massive wealth problem.
I'd argue taxes are a secondary concern to making money. I'd rather pay taxes on a gain than have no taxes because I made no money.
But think about the tax lock-in effect described by Portfolio Pilot. Let's say your concentrated bet wins. You put 20% of your net worth into NVIDIA 5 years ago. Congratulations. You are now trapped. You cannot sell without taking a 20 to 30% haircut in capital gains taxes. You lose flexibility. Your liquidity creates a prison. You can't rebalance. You can't buy a house. You can't diversify now because the cost is too high. Diversification maintains liquidity because you're constantly rebalancing as you go.
I'm sorry, but I just don't buy that as a primary argument. Landsberg Bennett points out that tax aversion is a behavioral pitfall. Refusing to realize gains or refusing to concentrate because of potential taxes leads to dangerous inertia. You're letting the tail wag the dog. If I have a massive winner, I can manage the taxes. I can use charitable trusts. I can borrow against the asset. If I have a diversified soup of mediocrity, I don't have a tax problem because I don't have any significant gains. I'd rather be in tax prison with a few $1 million than free on the streets with a checking account.
I want to reset the tension here because we're getting stuck on how many stocks. The problem isn't just the number, it's the exposure design. Diversification isn't just buying too many stocks, it's buying more of the same thing and pretending it's different.
I agree with that. Most people think they're diversified because they own 5 different tech ETFs.
Exactly. That is a false sense of security. Welton introduces the concept of the 4-asset portfolio. It's not just 500 stocks. It's stocks, bonds, trend following, and gold. Historically, these are uncorrelated. This is where true protection comes from. Exposure design, not ticker collecting. You need things that zig when the market zags.
That sounds nice in theory. It's the classic 60-40 logic extended. But look at the data from WTW and Welton regarding 2022. That year was a disaster for this theory. Stocks and bonds fell together. Correlation spiked to 1. Traditional diversification failed when it was needed most because inflation hurt both asset classes simultaneously.
That was a specific inflationary regime shift, which is exactly why Welton includes trend following and gold. Those were the assets that held up. If you only held stocks and bonds, yes, you got hurt. But if you were truly diversified across asset classes, not just stocks, you survived.
But it highlights the fragility of the concept. And look at accidental concentration, which WTW warns about. Passive investors, the ones you say are doing the prudent thing, think they are diversified,
but cap-weighted indexes are aggressively betting on the top 5 stocks. Nvidia, Apple, Microsoft, they drive 40% of the returns. If you buy the S&P 500 today, you aren't diversified. You're a concentrated tech investor with a lot of baggage. You're taking the concentration risk without the concentration upside.
I acknowledge that accidental concentration is a risk in passive indexing, but that reinforces the need for true diversification, alternatives, private credit, real assets. It's about being deliberate. If you are just collecting tickers, you are right, that is useless. But if you're engineering uncorrelated return streams, that is how you survive a decade like the 1970s or the 2000s where stocks did nothing.
Survival is one thing, but let's talk about the purpose of this wealth. Why are we doing this? Is the goal to just not lose?
That brings us to optionality and the sequence of returns risk. Allworth makes a critical point for the high earner nearing financial independence. The order of your returns matters immensely. If you are concentrated and you take a hit right when you want to step back from your career, say you're 50, looking to consult part-time, you destroy your longevity.
Why? If the average return is high, it comes back.
Because you are withdrawing money. If you have a portfolio of $2 million and it drops to $1 million and you pull out $100,000 for living expenses, you are cannibalizing the principal. You can't eat average returns. You eat the returns you get in the order you get them. Early losses in a concentrated portfolio can permanently wipe out the portfolio's ability to sustain you. You become a forced seller at the bottom.
That is a mindset of a wealth steward, not a wealth creator. The optimization paradox distinguishes between these two. Concentration is for climbing the mountain. Diversification is for staying at the summit. If our listener is still in the accumulation phase, adopting a defensive sequence of return mindset is premature. It's like playing the prevent defense in the first quarter of the game. You're just guaranteeing you don't score.
But at what point do you switch? That's the hardest decision in finance.
When you admit you don't know what you're doing. To quote Warren Buffett via Investopedia, diversification is protection against ignorance. If you know what you are doing, broad diversification makes little sense. Why put money into your 20th best idea when your first best idea is right there? Why dilute your conviction?
I knew you'd bring up that Buffett quote. It's the favorite line of every risk taker. But Acadian has a rebuttal to that exact sentiment. Buffett's quote ignores that most high earners suffer from the illusion of control. They confuse their professional success, being a great surgeon or a great engineer, with market prescience. They think they aren't ignorant, but the market humbles experts every single day. Concentration requires a level of skill that is statistically rare. Buffett is an anomaly, not a benchmark. Yet everyone assumes they possess it.
Or maybe it requires the courage to accept volatility as the price of admission for a different life. You call it the illusion of control. I call it having skin in the game. I trust my own research over a blind algorithm that buys companies regardless of their quality just because they are in an index.
Let's bring this to a close, because we have outlined two very distinct philosophies here. My position remains. Diversification is not about settling for average. It is about managing volatility drag and ensuring that a single black swan, a fraud, a regulation change, a tech disruption, doesn't wipe out a career's worth of earnings. It's about acknowledging that we don't know which 4% of stocks will win, so we own the haystack to find the needles.
And I maintain that concentration is the only path to true capital efficiency. Diversification is a comfortable way to bleed alpha while feeling responsible. You are paying a tax to avoid looking foolish, but the cost is the life-changing wealth you leave on the table by betting against your own best ideas. If you have conviction, back it.
We leave you with this final unresolved question. If the purpose of wealth is optionality, the freedom to do what you want when you want, at what point does protection stop preserving that optionality and start quietly preventing it by guaranteeing you never catch the 4% of winners that actually matter?
That is the paradox. Thanks for joining the debate. Make sure to like and subscribe for more finance debate videos. We'll see you next time.